Hello and welcome to episode 40 of 5 Minutes with Alex, a real estate podcast for the week of May 15th, 2023. In market news, rates have slumped, but why? Well, we have two major players right now, worries in the market about a looming debt ceiling deadline, but there's also the issue of banks raising capital amidst a rising interest rate environment. So let's talk about each briefly. So first, why are banks raising capital? You have to understand how banks make money. They need to find a return on investment that's greater than the interest that they are going to pay to depositors. So you put your money in the bank, you get a certain amount of investment. That bank needs to return a greater return on the interest that they're going to pay you. So with raising rates, there's a lot of money being pulled out of your traditional depository accounts, and they're put into other investment vehicles like money markets or CD accounts. And when that money does get pulled out, the bank needs to have the liquidity to honor that depositor. So if enough people do that, the bank needs to raise capital, make sure that they are meeting the needs of everything that they need to do in order to honor those depositors. So what can they sell? So they can sell investment vehicles that they have, things like treasuries or mortgage-backed securities that they're holding, which are probably returning a smaller investment than what they could get on the open market now, because most were probably bought prior to 2022. So this means that they have to sell it at a loss. Because if you have a mortgage-backed security, for instance, that's returning 2.5%, that's great that you're getting 2.5%, but mortgage-backed securities are returning 6 or 7% now. So they have to sell them at a loss. But from our perspective, why this is important is because this is going to push rates higher, because there's now a bigger supply entering the market, and thus there's not as much demand. So treasury and mortgage-backed securities, there's just not as much demand for these because there's more supply. 2, the debt ceiling. So this is creating a lot of worry for bondholders. Remember, financially, a source of power for the United States is our word, specifically our currency, our investments, our treasuries are viewed as stable. So if we default on our debts and we lose that status, guess what follows? Higher rates need to be charged because it's no longer viewed as the rock-solid flight to safety type investment, which means that things like mortgage-backed securities and mortgage rates would go up significantly. If the treasuries go up, then the more riskier things like mortgage-backed securities are going to follow. So in the face of no resolution on this matter, bondholders are spooked until an agreement is reached. In the mortgage corner, I've had a few conversations recently with realtors asking about pre-approval letters. Specifically, how the heck do I avoid a pre-approval letter that is not even worth the paper that it's written on? So I have a few thoughts here. First, I understand the frustration. I wish I could say that a pre-approval letter held a mortgage lender to a certain standard, but it doesn't. It should, but the reality is that it doesn't. I've seen pre-approval letters written where the client hasn't submitted a single financial document, or in some cases they didn't even have their credit pulled, which is crazy. So how do you avoid something like that beyond just reading what the letter says, or just calling them up and asking some point-blank questions, which is usually how it's handled right now. So here's the thing about calling and asking things like, did you verify income? Did you verify assets? I would say that if they're willing to put in writing that they have pre-approved a client when they in fact have not, asking them the question isn't going to get very far. But you can ask some deeper questions that don't violate the buyer's privacy that can give you an indication of the quality of the loan officer and the loan itself. So first off is, does your company offer an upfront loan commitment, meaning that the lender can underwrite and approve the financials of a client before going under contract? So this is a huge way to verify whether these have actually been verified. This requires not just a loan officer signature on it, but the company's underwriter to put their stamp on it. 2, who are the last 3 deals that you closed in this area? Now, you've heard the song and dance before. You ask any loan officer, they're going to say, we're fast, we're the best. Well, if they are, then the listing agents on the last 3 deals should be able to corroborate that. So that's obviously a little bit more time consuming, but if you're between 1 or 2 offers, that can be a good indicator of who is really good and who maybe isn't as good as they would like to make it seem. look at the details. When was that pre-approval letter dated? Is this over 30 days old? Read what the pre-approval is subject to. And finally, whose name is on the pre-approval letter? I know I'm preaching to the choir on this for a lot of you, but the highest offer doesn't mean anything if the loan can't close. The real estate world is a small community. You should be able to get a sense for that company's reputation. And if it's between, say, a couple $1,000s, and you're dealing with an online call center versus a trusted local lender, your client really needs to take that into consideration. Finally, our quote of the week: "You will never do anything in this world without courage. It's the greatest quality of the mind next to honor." Have a great week. If I can help you or any of your clients with any questions or pre-approvals, let me know. They can visit me at homeloanswithalex.com. Have a great week.